All right, we got to discuss tariffs tonight. Obviously, a lot of chaos over the weekend as we finished out the week. Last week on Friday, Trump announced that over the weekend, tariffs were going to be enacted on Canada, on Mexico, on China, 25% Mexico, 25% on Canada, 10% on China. And that obviously stirred a ton of buzz over the weekend. And then to see markets completely crater as futures opened up Sunday night. They remained in the red as markets opened this morning, but by about mid-afternoon, Trump had hit the pause after discussions with both Mexico and Canada on the Mexican and Canadian tariffs, and that allowed markets to almost fully recover. So this is 2 weeks in a row now. On a Monday, we've had a massive gap lower, only to recover almost the entirety of the way. And despite the roller coaster ride we've been on again over the last 2 weeks and everything that we've seen since the Trump administration has started, we are still all but 2% shy of all-time highs, at least on the S&P 500. So despite the volatility, very little damage done in the grand scheme of things. But we want to focus on tariffs tonight and really discuss two things that I think no one else is really discussing, explaining, but I really think you can only understand these things if you approach macro, if you approach markets from this kind of post-Keynesian MMT perspective. So that's what we're going to discuss tonight. If you're new here, get subscribed to that notification bell on. Ty and I are going to be going live later this week. We've been working on some models in our Deep MMT2 platform that, will hopefully kind of shed some light and demonstrate some interesting emergent behaviors on tariffs. We'll be showing those off on a future live stream. So notification bell on so you can get alerted when we go live later this week to discuss tariffs in more detail from kind of a system dynamic simulation standpoint. But tariffs, let's do this. Again, I think there are two things that kind of our framework can allow us to understand with tariffs that no one's talking about, but let's just get kind of the basic macro 101 understanding. The idea of tariffs is effectively, look, you're going to tax the importing of goods from an exporter for the sole purpose to make exported goods from the other country that you're going to import more expensive to make then domestic manufacturing, domestic goods just more appealing, cheaper for the consumer, in the hopes that gins up investment locally to produce those goods and services. And I think that's kind of the classic idea of what a tariff is attempting to do. Whether or not that is what is not taken out, what I really care about is what is at least when it comes to tariffs or anything, like what is the mechanism by which this all takes place? What is the effect on underlying flows, and what is the effect on kind of the underlying system state, if you will, of the macroeconomy? And that's really where, once you go from just kind of classic tariff 101 to kind of thinking about it from this kind of flow standpoint, right, this balance sheet standpoint, this is where you can end up seeing a couple of interesting things. And so number one, and a lot of people I think realize the end effect of what I'm about to say, but they don't understand the initial cause, the first cause of what I'm going to say is, above all else, a tariff is a tax. It is a tax that's paid by the importer of the exported goods, and it shows up directly on the daily treasury statement. And we'll start there in terms of things to look at tonight. And there it is, customs and certain excise taxes. That is where if you want to pull this up daily to see if and when the 30 days is up and the tariffs are maybe reimposed in March, if you want to see what that's going to look like, right there it is on the daily treasury statement. Now, a lot of people point out, hey, look, tariffs, and this is even Trump's whole argument, is that we could possibly even get rid of income taxes because we'll get a quote-unquote revenue source from tariffs. And a lot of people point out that this is a quote-unquote revenue source, but you have to understand is it's not really revenue, right? This is money that is now being removed from the private sector, just like taxes are, and being brought on to the balance sheet, in this case of the TGA. It would be a revenue source for the TGA. So this is money just being extracted from the private sector into the public sector. And again, this is kind of, the key MMT insight of everything that we do here, is that when the government spends, that adds financial assets. And when the government taxes, that removes financial assets. And since a tariff is just effectively a tax, the first order effect is that tariffs will kill growth. It is just a removal of a source of income that is in the private sector that is now not there, that is now essentially being removed from the private sector. In this case, it is technically a revenue for the TGA, but that is a removal of financial assets. The private sector is now poor because of it, because of the tariff. And the first order effect of that, just like any tax, just like any slowdown in government spending, is that it will always lead to a slowdown in growth. There is a direct connection between government spending and growth. This is going to remove the total deficit or slow down the total deficit, and therefore the first order effect is just a hit on growth. So before you talk about the implication of tariffs, or the implication of, like, say, inflation, tariffs on inflation, or any other knock-on effect down the line, the first order effect, it's a tax. It is removing the total amount of assets, or removing from the total amount of financial assets in the private sector in the form of that tax. And that is going to be a headwind towards growth unless you can ultimately spend more to offset the tariffs. Now, the next argument that is often made with regards to tariffs and the implication of tariffs to the macroeconomy is that tariffs are inflationary because there is a pass-through or a pass-on cost from the importer to the consumer. And this is where things kind of get interesting. And this is where I think another unique observation, again, when you understand things through this post-Keynesian heterodox MMT view, is you can understand that depending on what firms do with that additional tariff cost is going to ultimately kind of set the stage for if tariffs will be inflationary or not. What I'm going to do is I'm going to pull up a study. This has been widely cited. I think not only was it published here, this is a Harvard publication, but I also think it was published in the NBER as well. A very popular study that's been cited quite a few times that showed that following the 2018 tariffs that Trump instituted, that ultimately we did not get any boost to inflation, and that what ended up happening is instead of those costs, the higher costs being passed on to the consumer, effectively the firms just ate that by reducing their profit margins. And so we never ended up seeing a big boost in inflation. And so granted, there is a one-time cost adjustment because of those tariffs. It's up to the firm to decide, are they going to pass that along to the consumer, or are they just going to eat that in terms of lower profit margin. So keep that point in mind, and just to show that is exactly what played out. We never really saw, following the 2018 tariffs, any major jump in CPI. We have CPI pulled up here, and in fact what we did see is we saw an ever so slightly decline in real GDP and growth overall as we headed into 2019, and some studies have attributed that to those very tariffs. And this is kind of the next piece to the puzzle, if you will, as to what the implications of tariffs are. If in this instance, in the 2018 instance, if you end up seeing profit margins take the hit, right? So firms just go ahead and swallow the additional cost of those tariffs and they lower their profit margins, that is now a double whammy against growth, because if you think about it, one, you just have the initial kind of tax burden, if you will, on the private sector that ends up getting paid, but then and everything we just talked about is the headwind to growth. But now you're also seeing firms' profits reduce. And if you go back to some of the things we've talked about in terms of how firms decide to go ahead and expand production through credit creation, they do so based on the fact that as profits push higher, their desire to create new loans increases, and this spurs on economic activity and gets us into that kind of reinforcing cycle upwards. Well, if firms decide, hey, at the end of the day, we're going to punish our consumer base so much that it's going to hurt our bottom line more to pass these on in terms of higher cost, we'll just reduce our profits. Then what that means is they are now less likely to go ahead and invest into future production, and that is also going to slow down growth. So tariffs pose a double risk to growth. One, again, just because they're removing financial assets, and then two, because if it's decided that firms are just going to reduce the overall profits that they intend to make from their productions of goods, then that will then reduce their investment, which stops kind of the virtuous cycle upwards. And so that is a realistic possibility. And I think based on the data, based on what we saw with CPI and based on what we saw with GDP, you could make a very compelling case. That is exactly what played out following the 2018 tariffs. Now, let's play out the different role that didn't happen, the counterfactual. What if, and this is very well where we could be, and I think this is possibly likely, what if it was determined by firms, by producers, that in fact they can pass that cost along, right? If they feel like they can pass that cost along, if they can keep their profit margins high, again, we could easily be in that scenario, then that means you will see at the very least a one-off inflationary adjustment that will be passed along to the consumer in forms of just higher prices. But then what this does is this then means that the firms will continue to get the higher profits, assuming there's enough income, and that's a big assumption, but assuming there's enough income for consumers to go ahead and kind of eat that higher cost, then that means the profits will remain there for firms to continue to kind of push their way up the we'll call it the Minsky investment curve, and continue to take out more loans to then create higher production and expand output, and then continue to see higher growth. So there is a very real possibility, and again, this is I think the second thing that no one's talking about, is that there is a path for these to be inflationary. And in one sense, and this is kind of the key insight here, to a certain extent, if you want a growing economy, you almost want tariffs to be inflationary, right? If we want this bull run to continue, we better hope that tariffs end up being inflationary, because that means that at the very least, it's that the firms aren't taking the hit right away on profits, that they're at least allowing the consumer to decide that it might end up being at least a one-time price adjustment, inflationary pressure higher. And if that's the case, and it doesn't end up hitting into the bottom line too much, that we could continue to see what it is that I think we're absolutely seeing at this point, which is kind of the next big credit boom taking off. And so at this point, look, one, we're going to get a 30-day pause regardless of tariffs. We'll find out in March if they end up getting enacted or not. It seems like this is certainly something that is still, very much what Trump is looking to do. But we'll find out if they do get enacted and if they do kind of come back online, what that's going to look like. And if they ultimately are not inflationary, that's going to be a macro concern, and that could end up getting this kind of, what has been a very bullish macro environment to finally tip over into a possibly bearish environment. So hopefully that was instructive with regards to what could take place with tariffs if and when they finally get enacted. Look, if you're an active trader, active investor, you like this type of research, you want tools and models to help you navigate markets, make sure you check out appliedmmt.com. Get signed up. We have a ton of updates, ton of models, ton of tools that track all this data in real time. So if that's you, check it out over there, appliedmmt.com. Other than that, good trading, everyone, and we'll talk to you next time. Bye-bye.